All right, ladies and gentlemen, Canada's $78.3 billion deficit budget just dropped. The Bank of Canada might just have to cut rates again, and as if it wasn't enough stimulus. The good news, if you're buying a new home under $1 million and you are a first-time home buyer, apparently the program is actually going to come into place and you might save $50,000 in GST. The bad news, most of the $20 billion of new spending so far won't hit the economy until 2027. Mortgage rates might actually drop further to 2%, which is another quarter point drop because the budget was so weak. And if you're in the real estate market, your 2025, that's the rest of this year, is probably not getting saved by government stimulus, at least. Here's exactly what the budget might mean for you, your mortgage, your home, and your business. Now, let's be real. It's only been 24 hours since the budget was launched, and I've got a lot of keynotes. There's probably more information that's going to come out in the next week or two. And if you own a home or you're a Canadian, this information is going to matter to you. All right, Canada's budget dropped 2025, Tuesday, November 4th. And I'm going to be honest with you. For residential real estate, it was mostly a snooze fest, putting us to sleep. The deficit came in at a whopping $78.3 billion. It's higher than the parliamentary budget actually expected, which was supposed to be 68.5. Guys, like, this is crazy. And it's below the worst case fears of $100 billion. Now, they announced $20 billion in net new stimulus, which sounds big, right? But here's the problem. Most of it doesn't hit the economy until 26 or 27. We've got defense spending, we've got infrastructure, we got long-term projects, and economists are saying that's not enough fast enough, which means the Bank of Canada might have to cut interest rates again, maybe even below the 2.25% that they wanted to go to, because fiscal policy is possibly not pulling its weight. So today I'm going to break down the three things from this particular budget that actually matters for you if you're a homeowner or someone interested in the real estate market. Number one, the GST rebate for first-time homebuyers. It's back on the table. Number two, what weak stimulus actually means for mortgage rates. So what that's going to mean for you in your renewal next year, and why this budget might actually hurt house prices in the short term. Good thing if you're someone interested in buying, not good if you're someone who wants to see your home value increase. Now, let's start with the one thing that the budget actually directly addresses, and that is the GST rebate on new homes up to $1 million. Oh, that GST rebate, the GST rebate that was talked about back in May of 2025. Now, this, again, it's not new. They announced it earlier this year, but the budget confirms it's currently before Parliament as part of Bill C4. Now, as a reminder, here's how it works. This applies to new homes purchased directly from the builder for properties up to $1 million. An effective date was anything from May 26, 2025 or later. So yes, if you bought a pre-sale or a new home, I should say, and you bought it after that date, technically you should be eligible, but we'll see. Anybody who bought before May 26, there's no exceptions to it. The math on it's really simple. On $1 million home, $50,000 of GST, the government rebates that money back to you. It is not off the purchase price you have to pay up front, and it's rebated back. On $750,000, that's $37,500. On a $500,000 home, that's $25,000. That's real money. But here's what it doesn't do. It doesn't apply to resale homes, obviously. It doesn't help you if you're buying for another homeowner who's bought that pre-sale, even if they haven't lived in it. It doesn't change your mortgage qualification anyway, because you still have to qualify with the GST. And obviously, it doesn't have any impact on supply. So who wins in this? Obviously, first-time home buyers buying new construction from builders. That's it. Not a very big part of the market, to be honest with you. Will it help affordability in any reasonable way? Nah, here's my concern. Builders know about the rebate. And basically, the economic studies say when the government subsidizes demand without increasing supply, prices rise to capture the subsidy, which in translation basically means the $50,000 GST savings might just get backed into higher prices, and you save the 50, but they charge 40 more. The chances are there's not very much savings. And we've seen this with government programs before. First-time homebuyer incentive, it didn't improve affordability. 30-year amortizations, it does help cash flow. Not ideal for long-term wealth, but it helps people get into the marketplace. So I'm not going to slag on that one too much. Still, if you're buying new construction anyways, it's free money, take it, but don't expect it to give you any other extreme revolutionary affordability metric. Now, here's where it gets more interesting for mortgage rates, because what's not in the budget, in this budget specifically, might matter more than what is in the budget, if that makes sense. Remember, the Bank of Canada cut rates to 2.25% just a week ago, and they said we think rates are about the right level. Translation meant we're done cutting unless something changes. Well, something changed. The budget stimulus is a problem. BMO Economics calculated that the budget includes roughly $20 billion freaking dollars in net stimulus, but capital economics economist Bradley Saunders broke it down like this. The fiscal year, the 25-26, only $4 to $9 billion in new spending hits the economy only. The rest, long-term defense, $63 billion over 5 years, infrastructure, $13 billion over 5 years, is already announced programs. He said, with the majority of spending focused on long-term defense and infrastructure projects, today's announcement increases the likelihood that the Bank of Canada will have to cut its policy rate below neutral to support growth, which in translation basically is the budget was too weak, too slow, so the Bank of Canada might need to cut rates again to pick up slack. Crazy, right? Here's what other major economists are forecasting about rates. Capital Economics says 2 more rate cuts after this announcement. By January 2026, then it cuts back up to 2.25 by 2027, which brings us back to where we are today. Desjardins says we're going to follow a quarter point, and that's going to happen in early 2026. Oxford says we hold it 2.25%. They might drop to 2% next year. But the market consensus overall is basically saying that because of this news, we're going to see a quarter point rate cut if the economy goes any weaker. Now, the bank said that their rate is the right level, but that assumed that the government steps in with fiscal stimulus. If the fiscal policy doesn't deliver, and this budget suggests it won't, and in short term, then monetary policy may have to step in and compensate. So what this means for your mortgage is that if you're on a variable rate right now at, say, 3.45%, like a super awesome variable rate, what could happen is that the BOC cuts to 2%, your rate drops to 3.2, and you're saving like $60 for every $600,000 mortgage. If the BOC holds at 2.25%, you stay where you are, and if they hike back up, then rates would go up, right? If you took a fixed rate today with what would be similar to some of the best rates at about 3.89 for an insured mortgage, the 5-year bond yield actually did go up a little bit after the budget because the market saw the deficit and worried about the debt, but it quickly reversed. Basically, fixed rates should stay in the range that they're at right now, but there is upward pressure, which means we could see fixed rates go up 10 to 20 basis points in the coming weeks. But the bottom line is that the budget's weakness might actually give you one more rate cut in early 2026 if the economy stalls. But long term, most of the economists are thinking we're in this 2 to 2.25% range for the next couple of years. Now, let's talk about what this budget does for housing supply. Spoiler alert, not much that helps anybody in the housing market create more supply or more inventory. The government is pouring $13 billion into Build Canada Homes to support construction for affordable homes for those likely to rent. Translation, we are back to this turning Canada into a nation of renters. This isn't for middle-class families. This is for renters and low income. And now, I'm not against affordable housing. Yes, we need it. But if you're a homeowner wondering when inventory improves, this is not going to help you or solve the problem. This is the manufactured home crazy carny vision that is out there where they're spending $13 billion on homes that are nobody's going to finance. It's just mental, in my opinion. And here's the parliamentary budget offers take. Canada needs only 290,000 homes per year to supply to close the gap. We're building around 230,000. So we're short by 60,000 units, and they think they're going to do this by giving us a $13 billion program over 5 years. That's $2.6 billion per year at average construction costs of $400,000 per unit, including land and infrastructure. Like, we're talking about 6,500 total units per year. We need 60,000. They're giving us 6,500. Do the math on that. The other thing to think about is the Canada Secondary Suite Loan Program. Yeah, you haven't heard of that because they talked about it months ago, in fact, years ago. That got axed. That was a program that was supposed to help homeowners add rental suites to properties by using up to $80,000 in below-market loans. Axed before it even launched. This is because the government says it overlaps with the insured mortgage rule changes in January 2025 that let you refinance to build a suite, which honestly nobody has used. I've never even seen anybody ask about it. But those are two totally different programs, and one was a standalone for construction. The other one was a refinance that increased your mortgage debt, requiring you to requalify with the stress test. Crazy stuff. This program actually could have had some promise. Secondary suites increase density without new land. They help homeowners generate rental income. They create more affordability. They create supply. Dead before launch. Classic government move. Announce it for the headlines and then kill it before it's even on the ground. Again, CMHC's $80 billion Canada mortgage bond increase. Now, one thing that does matter for lenders is that CMHC is increasing the Canada mortgage bond annual issuance limit from $60 to $80 billion. This is specifically for multi-unit rental financing for multi-unit properties. So there's more liquidity that's going to help out those commercial loans to build more apartment buildings, basically. That means there's marginally lower insured borrowing costs for multi-unit projects, which is good news for developers and those building purpose-built rentals. That doesn't help single-family homes or properties for those people that are looking at family-related properties. So if you're in the commercial space or working with developers, it's a win. More capital available for less money. Win, win, win. All right. Let's talk about what's not in the housing sector, but actually matters pretty significantly. This thing called immigration. The budget confirmed the following: permanent residents of $380,000 per year for 26 to 28, down from $395,000 thousand people this year. Temporary residents in $385,000 in 2026, and then $370 in 2027-28. Temporary foreign workers are getting dropped by 50%. International students are going down 60%, which is wild. And it sounds like we're already down 30% this year alone. So what does this actually mean? Housing demand, it will fall. It's not stabilizing. It is going to fall. We've been building for 500,000 plus people per year, but now we're targeting under 400,000 permanent residents plus declining temporary residents, which means fewer buyers, fewer renters, and less demand pressure. And if you combine that with high interest rates relative to 2020, 2021, tighter mortgage qualification, economic uncertainty due to the tariffs, 1.2 million mortgage renewals in 2020, 2025, facing some kind of a payment shock, you get soft demand, which is exactly what we're seeing in the marketplace right now. And for people in the real estate space, this means 2025 could be pretty stagnant. Inventory is high, demand is soft, and buyers are cautious right now. For anybody who owns a home, if you're selling, price aggressively. The government is not going to help you with any stimulus on this. All right, let's connect all the dots here. What does this budget actually mean for home prices? And the budget provides very minimal stimulus short term, which basically means the economy stays weak, unemployment likely rises, consumer spending stays soft, and housing demand remains subdued, which is where it is right now. Plus, you get 1.2 million mortgages renewing in 2026, 2025, 2026. These are people who locked in at 1.5 to 2%. They're renewing at 4.5%. That's a big difference. If you multiply a difference in monthly payments by approximately $800 on average over the course of a million families, that's billions of dollars per year in reduced consumer spending, which is massive. Money that would have gone to renovations, furniture, restaurants, now goes to mortgage interest on properties. And that is deflationary for home prices, folks, because those families are not typically buying bigger homes. They're barely holding on to the homes that they have. In the medium term, there's the paradox, which is that if demand is soft now, builders stop building, new home sales are down across the board almost everywhere. Builders are laying off, canceling projects, and waiting. Let's fast forward to 2027. Let's fast forward to 2028. That construction freeze basically means there's not going to be any supply hitting the market. Meanwhile, immigration is going to stabilize. Mortgage rates will have normalized, ideally. Millennials in their 30s will want to and need to buy by that time. And Gen Z at that point will be entering their buying years. Hence, the demand will come back, supply won't be there, and prices probably spike in 27, 28. They probably go up. We've seen this movie before. Every single housing crisis in Canada, prices drop, builders stop building properties, supply dries up, prices surge. So if you're buying now in a soft market, you might be early in this market, let's be honest. But honestly, you're probably not wrong to buy, because in 3 to 4 years, you'll be glad that you bought a house now. And I'm not telling you to rush in the market. I'm just telling you this is a likely occurrence. So given all this information, like, what do you do? So if you're buying, honestly, my feedback is don't wait for government programs to save you. They're not coming. The GST rebate helps if you're buying new construction, yay, but there's not going to be some magical policy that makes everything more affordable. And I don't think anything is really coming. If you can qualify at today's rates, this is probably as low as it gets based on what the economists are forecasting on the fixed rate side. And if you take a variable, you might see a little bit of room to go down. Immigration is down right now, which means demand is soft, which means you have more negotiating power than you ever have. Most of the economists are predicting spring of 2026 to see more competition as rate cuts have worked their way through the system. Now, if you're renewing your mortgage, don't stick with your same lender. Your bank's first offer is probably not going to be great. Consider maybe a 2 to 3 year fixed term instead of a 5 years, because rates are expected to have bottomed out or be close to bottoming out. But also, you need to weigh that with your personal circumstance. So, the long term might make sense from a security perspective. But at the end of the day, you've got choice right now. And if you're selling a property, my biggest piece of feedback is price aggressively. The market is not going to get saved by this budget. Inventory is high and demand is soft. Buyers have choices right now. They're not going to go look at your property if there's another one across the street priced better that is relatively similar. And if you're serious about listing, I would probably get out sooner than later. Although November and December typically favor buyers, waiting till spring in this budget could mean you're gambling at lower price points. We'll see what happens, though. Look, my feedback is that Canada's 2025 budget was a dud. Anything to do with real estate, there's a $78 billion deficit, $20 billion of stimulus that mostly lands in 2027, so 2 years out, and a GST rebate that we already knew about. The good news is that variable mortgage rates, a BOC, if you're at a variable rate, could drop by a quarter point, which means the budget was so weak that the Bank of Canada has to compensate. The bad news, that means the economy is not doing very well, and that means everything is going to soften as far as house prices. So, long story short, a lot to take away. The key payoff considerations that I talked about today mean that budget probably doesn't move the needle for most people in housing, but there are some important considerations that you need to pay attention to. If you found this helpful, give me a thumbs up, subscribe. And of course, if you want to find out about your upcoming mortgage renewal or purchasing your property, hit the details in the link below and see how we can help you.